Module 8. Investing. Investment refers to the allocation of money or resources with the expectation of generating a return, typically in the form of income or profit. Investments can take many forms, such as buying stocks, bonds, or mutual funds, investing in real estate, or starting a business. Net present value, which we discussed in the last module, is a financial metric used to determine the value of an investment or project. It measures the difference between the present value of cash inflows and the present value of cash outflows over time, considering the time value of money. The idea is to compare the costs of the investment with the expected benefits, adjusting them to their present value. A positive NPV indicates that the investment is profitable, while a negative NPV indicates that the investment is not. The formula for calculating NPV is the present value of all the cash flows expected, minus the present values of the projected investments. We covered this in more detail in the last module. The interest rate used in this calculation represents the opportunity cost of investing in the project, and is typically the same as the company's cost of capital. The result is expressed in monetary terms, which means it provides a clear picture of the profitability of the investment. The higher the NPV, the more profitable the investment. Choosing the better investment. Choosing the better investment involves comparing different options and selecting the one that offers the highest return with the least risk. To make a sound investment decision, investors consider various factors, including the potential return on investment, the level of risk, the duration of the investment, and the investor's financial goals and risk tolerance. One of the most common methods for evaluating investments is calculating their return on investment, often abbreviated as a ROI. ROI measures the profit or loss generated by an investment, expressed as a percentage of the initial investment. The formula for calculating the ROI is the gain from the investment divided by cost of investment. If the investment return is spread over many years, you can also express ROI on an annualized basis. When comparing two or more investments, the higher ROI is generally considered the better investment. However, more than ROI is needed to provide a complete picture of the investment's potential profitability or risks. Other metrics such as net present value, internal rate of return, and payback period may also be used to evaluate investments. Investors should also consider the level of risk associated with each investment. Investments with higher returns often carry higher levels of risk, while investments with lower returns may offer more stability and less risk. Ultimately, choosing the better investment requires careful consideration of all available options, such as potential return, risk, duration, and financial goals. For example, assume two mutually exclusive investment opportunities require an initial investment of $8 million. The company can only afford to do one of them. Investment A pays $1 million per year in perpetuity, while Investment B pays $600,000 in the first year, with cash flows increasing each year by 5% per year after that. Assume that cost of capital is 10%. To compare the investments, we can use the perpetuities formula, which, if you recall, was the value equals the payment, or cash flow, divided by the rate minus the growth. For Investment A, the annual payment is $1 million. Divided by the rate, which is the cost of capital, of 10%. There is no growth, so the denominator is just the rate. 1 million divided by 10% is $10 million. So, Investment A has a present value of $10 million. For Investment B, the payment is $600,000. Divide that by the rate, 10%, minus the growth, 5%, for a total denominator of 5%. $600,000 divided by 5% is $12 million. So, despite the much smaller initial return, Investment B actually has the higher present value than Investment A, $12 million to $10 million. Debt. Debt refers to money or other financial obligations that one party owes to another. Debt can take many forms, such as loans, credit card balances, mortgages, or bonds. When an individual or organization borrows money, they agree to pay it back with interest over a period of time. Failure to repay the debt can result in penalties or legal action. Effective cost of debt. The effective cost of debt refers to the actual cost of borrowing money from a lender, considering all the costs associated with the debt. This includes the interest rate on the debt, any fees charged by the lender, and any other costs incurred by the borrower in obtaining and servicing the debt. To calculate the effective cost of debt, the borrower should first determine the interest rate charged by the lender. Then, they should add any fees or charges associated with the debt, such as loan origination or annual maintenance fees. Finally, they should consider any tax benefits associated with the debt, such as tax deductions for interest payments. For example, if a company issues a bond with a 5% coupon rate and $1,000 face value, the nominal cost of the debt is 5%. However, the effective cost of the debt will be higher once the fees associated with issuing the bond are considered. Additionally, the effective cost of the debt may be lower if the interest payments are tax deductible. Calculating the effective cost of debt is important because it allows borrowers to make informed decisions about taking on debt and compare the costs of different debt instruments. Assume that the outstanding debt of ABC Corporation has a yield to maturity of 5%. The tax rate of ABC's income is 20%. The effective cost of debt considers the tax savings resulting from the tax deductibility of interest payments. The formula for the effective cost of debt is the yield to maturity times 1 minus the tax rate. Plugging in the given values, we get effective cost of debt equals 5% times 1 minus 20%, or 5% times 0.8, for a total effective cost of debt of 4%. Weighted average cost of capital. The weighted average cost of capital, sometimes abbreviated as WACC, is a financial metric representing the average cost a company pays for its capital, including equity and debt. It is used as a discount rate to evaluate investment projects or as a benchmark to assess a company's overall cost of capital. To calculate weighted average cost of capital, a company's debt and equity costs are weighted by the proportion of debt and equity in the company's capital structure. To calculate the weighted average cost of capital, you have to consider that different investments or structures the company operates might come with different costs of capital. Cost of capital for a loan is as simple as the interest rate you're paying on that loan. As discussed above, cost of capital for a bond you issue is the bond's yield minus whatever tax savings you're realizing based on the bond structure. Cost of capital for other money tied up in an investment is the opportunity cost that you're sacrificing by tying up that money. For example, XYZ Corp has capital tied in 3 investments. Project A uses $1 million, financed through a loan with a fixed 6% interest rate. Project B uses $2 million, financed through a loan with a fixed 5% interest rate. Project C is financed by $2 million from the company's cash reserves. Had it not invested this money, XYZ could have earned 3% interest by investing in government bonds. Project A represents 20% of the total invested money, $1 million divided by the $5 million total. So, we weight the project's 6% interest rate by multiplying it by 20%, for a total of 1.2%. Project B represents 40% of the total invested money, since it's $2 million of the $5 million total. So, its 5% cost of capital is weighted by multiplying is by 40%, for a total of 2%. Project C has an opportunity cost, and thus a cost of capital, of 3%. It also represents 40% of the invested money, so we'll weight it by multiplying 40% times 3%, for another 1.2%. We can then add the weighted cost of capital for Project A, 1.2%, to those of Project B, 2%, and Project C, 1.2%. So, the total average cost of capital for the three investments sums to 4.4%. Now, when calculating the projected value of XYZ stock or any other purpose, we can assume a company-wide cost of capital of 4.4%. By weighing the cost of equity and cost of debt, weighted asset cost of capital provides a comprehensive measure of the cost of capital a company faces in financing its operations. The higher the WACC, the more expensive it is for the company to raise capital. The lower the WACC, the cheaper it is.